I wonder, from a rate strategy standpoint, this has got to be, this coming year, the most telegraphed set of interest rate hikes we've seen in quite some time. Is there anything that can catch the markets off guard, knowing that the Fed is now predominantly tilted towards normalizing monetary policy?
So you're right that the Fed has been communicating that they want to start to normalize. I think where the uncertainty comes in is the pace, the endpoint, the sense of urgency. So the rates market has been extremely volatile in the last month because the Fed's gone from this might be transitory, we can be really gradual, to let's start hiking the moment we end tapering. Remember, just a couple of months ago, the Fed was saying tapering and tightening are actually two different policies. Well, we expect them to end tapering in March and turn around and hike right away. So I think that sense of urgency is what's going to create volatility. We're going to be really watching that long end of the curve. I'm actually looking for much higher long end rates because the Fed, apart from hiking, they're going to be letting the balance sheet run off. And I'm a little nervous about that balance sheet runoff because it's a large balance sheet and it's short duration maturity bonds. So a lot is going to run off. The US Treasury will have to issue a lot more treasuries. And if those long end rates, if the 10-year gets above 2%, 2.5%, I think then it does start to impact risk assets. So I'd be watching that long end. It is telegraph, but it's really the pace that could shake markets here.
All right, so Priya, let's talk about the pace then. First of all, I guess maybe I should say part one of my question is, how many hikes do you think this year? I think 3 is probably the consensus. That's what most people are telling me right now. Some people, like Goldman, say 4. Others say 4 as well. Some others say maybe 2. Where do you stand? And then how fast is too fast?
So we've got 3 hikes and balance sheet runoff. I mean, I want to stress on balance sheet runoff as being a pretty strong form of tightening that the Fed has. They have that tool. We think they're going to use it near year end, and it'll substitute for a hike. I think the question is next year. You know, we expect 4, the market's pricing in 3. What about the year after? So it's really the entire tightening cycle, the end point of that tightening cycle that needs to get priced in. I mean, your question of how fast is too fast, ultimately it is going to depend on the economy. Now, our view is that there is a lot of fiscal drag this year. I mean, Omicron can have a short-term impact on service demand, but later on this year, when that fiscal support starts to step away and real incomes are not growing that much, you talked about high inflation that's eating away into purchasing power. We do think the consumer spending component is going to slow down. So that's why I think 3 is enough. You start talking about 4, balance sheet runoff, long end rates rising. I think it's going to be a headwind for the consumer apart from fiscal drag. So I would argue 4 or higher is too much, unless we get another form of support for the consumer. But I don't think we get much more fiscal support.
So Priya, okay, you take a look at the scenario that you just laid out. What does that then mean for those long end rates, specifically the 10-year, because so many things are benchmarked off the 10-year, including my home mortgage right now? What exactly can we expect when you say that it's going to rise by how much? Are we talking 2%, 2.5%? Is it 3%? Where does it end?
So we're forecasting 2.25 by year end. So that, you know, it's still a good 50 basis point increase. And I think that we can still handle. We start getting up to 2.5%, 3%. Remember 2018, the 10-year got to 3%, and that marked the end of the hiking cycle. So I do think that anything above 2.25, 2.5 starts to become danger zone. I would also look a little deeper at real rates. Is the rise in long end rates largely inflation expectations led, or is it real rate led? In the last couple of weeks, there's been a real rate move. And so if the entire move is real rate, it starts to have more of an impact on financial conditions, on the dollar. You notice the dollar has really been hasn't risen as much because it hasn't been a real rate move. But if the Fed starts acting, and I think I'll be watching Governor Brainerd, if she has that sense of urgency as well, real rates start to move, I think it has more of an impact on the economy as well as financial conditions.